Hello, college accounting scholars. Welcome back to chapter 10, section 2. Hey, we're on the revenue cycle, and we're now going to delve into when revenues are recognized. Okay, so the best way to learn this type of theory is actually to apply it. So let's take a couple examples here. Revenues are typically recognized when they are earned. Again, it's not about being received. It really doesn't, in an accrual accounting system, it has nothing to do necessarily with when the cash is received. Unless you literally get the cash when you take the order. But let's assume here a December 31st year end for the following examples. So for example number 1, you provided the services in November, you sent the bills out in December. Which month would you recognize the revenue in? Would it be November or December? So the rationale here is that revenues are recognized when they are earned, when you have actually performed them, regardless of when cash is paid. So in this particular case, the recognition would occur in November. So the answer to example 1 would be November. All right, let's take example 2. You've received payment in November for services provided in December. When would you recognize the revenue? Well, here again, the principle that applies, the client would pay, in this particular case, paid us in advance. You've got the money in November, but the services are actually provided in the next period, which is December. So you would not record it in November because you have not performed the service. You would have an obligation to perform that service in the future, and when those services are performed, you would then make the adjusting entries to the record that would relate to revenue earned. So in that particular case, the recognition would occur in December because that's when the revenue was earned. All right, and example 3, you've provided services and received payment in November. When would you recognize the revenue? And here again, the principle involved is you provided the service and you were paid for the service. So since you have performed it in November, the revenue would be recognized in November. All right, so those are 3 great examples. Let's take a little more complex problem here and get a little better understanding in terms of what the accounts that are used in the revenue process. And actually, there are 3. There's a sales account, which is revenue earned, and typically this would be on a gross price basis. There's the sales and returns and allowances. Again, this would be on a gross price basis for the merchandise that is returned or allowances given to the buyer. And then there's sales discounts, the actual discounts that are granted to the customer. So those are the accounts that would typically be involved in the sales portion of the revenue process. So make sure you've got those well defined in your notes. Okay, so let's move on to an example here. So let's say you sell $800 of inventory to a customer on account for $1,200, and the terms are 210 net 30. Again, the 210 that basically says you're going to give the customer a 2% discount if he pays within 10 days. Otherwise, if he does not pay within 10 days, if he pays in the 11th through 30th day, which is the normal terms, net 30, which is the N/30, he would not get the discount. So what happens is the customer says, okay, you ship me all this stuff, I'm going to return $200 of inventory, and I would like a $300 credit. Remember, the $200 is your inventory cost. The $300 is essentially what the customer paid. So the customer pays the bill within the discount period, and we're going to make the assumption that a perpetual inventory system is being used here. So how would these events be recorded? So it's relatively straightforward. The amount that was sold was $1,200, so you would debit accounts receivable, you would credit sales. The associated cost with those sales, the inventory cost, is $800, so you would debit cost of goods sold, and you would credit your inventory account. You have some sales returns and allowances here, which is $300 as stated in the problem. So you debit sales returns and allowances, you credit accounts receivable, and then you have to make a similar transaction to your inventory account. So the cost of goods sold would be credited by $200. And since the customer took the actual sales discounts paid within the 10-day period, we'd have to figure out the actual amount associated with that. So that calculation would be a result in a debiting of cash, as well as sales discounts with $882 and $18 respectively, and then you would then credit the full accounts receivable that is left after the sales and return allowance, which is $900. So make sure you understand the logic of this. It's a good thing to make sure you've kind of got tattooed on your mind at this particular point. Okay, so the other part of this is what would happen if the payments were made after the discount period. So he didn't take the discount, and simply put, the transaction here would involve a debit to cash for $900, which is the net after his returns, and a credit to accounts receivable. All right, so we got a couple thought questions here, and the thought questions are: why would we not simply credit sales for the returns? Well, the reality here is the reason we do not simply credit sales for returns is that, unlike the case where it's just an accounting transaction, management really needs to track the amount of sales that are subsequently returned. The reason they need to track that is because it could become a quality issue. So they need to basically keep a separate account in order to make sure that they're on top of any potential quality issues. And then the second area is why not simply credit sales for the discount or record the sales net of discount? So here again, unlike the situation with purchases, management needs to know the amount of discounts. Are the salesmen, giving too many discounts, just to get sales? So they want that information centralized so that they can understand the discounts that are taken by customers, and they can evaluate their credit policies. So that's the two reasons for why not simply credit sales for returns, and then the second reason why not simply credit sales for the discount or the record of sales. It's really management information that they need. All right, guys, we're going to end it here. Have a great evening, and I look forward to seeing you tomorrow in class.